we were looking at these lows down here on the 1 minute chart. Okay. And let's assume that we were considering how the market is recently trading at all-time highs. And I'm going to address that here because it's also a question that keeps coming up a lot still, even though I answered it in my comment community section on my YouTube. When a market trades into all-time highs, I am completely in the same category as every other trader. I don't know what it's going to do. I don't know how far it's going to go higher. You don't know how far it's going to go higher. You don't know when it's going to stop. You don't know if it's going to reverse. No one knows that, folks. So with this in mind, apply that same logic of, okay, if you subscribe to the idea that a higher time frame weekly or a monthly or daily chart is suggesting prices are going to be bullish, you want to limit your focus to being a buyer. That does not mean that you can't find scalps that go short on, but if you don't know what you're doing, or if you're lacking consistency, or you really can't read price all that well, start with just having a higher time bias and only study price action without pushing the button with that in mind. Now, with that premise, we can see that we are in 7 o'clock in the morning. So 7 o'clock is the New York kill zone. So at 7 o'clock in the morning, I can start looking for setups in any market. And I said this before, but it goes over the heads of some of you because you're not really doing too well in terms of taking notes. There are things that I'll talk about that are specific to Forex, and there are things that I say that are specific to futures. And unless I say that at the time of me teaching it, everything I say is universal. That's my belief, okay? So at 7 o'clock in the morning, that starts the New York kill zone. So if we have that delineated, sometime after 7 o'clock, I'm bullish. Why? Because we traded at all-time highs. I don't want to try to pick the top. I don't want to be a sucker and try to, do something that's impossible. So I want to look for areas where the retail trader that wants to sell short or try to pick the top, or aggressive traders that think they're going to outsmart the marketplace, they're going to buy early. And by buying early, they'll place a stop loss below a low that forms just after 7 o'clock in the morning. So here's 7 o'clock. We have a low. We went lower here, but see how shallow that was? You see that? Does that imply a continuation the rest of the day? Probably not. And as we get closer to 8:30, 8:30 is usually a turning point, because whether there's news or not, and there really isn't any news of any significance until 10 o'clock today. Some kind of manufacturing index number or something. And we'll get to that when we get into 9:30 going into 10 o'clock with the opening range. But this low here, this run here, it runs to this high to take out the liquidity. This low takes out the liquidity below here and here. See that? Nobody's ever done this before, okay? I'm telling you, I'm that confident that this is what it does every single day. It does this every single day, and it's not going to stop. There's going to be times that I'll read it wrong, but this is what's going on every single day. The market will trade to liquidity for the purposes of stopping out people that would be profitable at a later time when the market does run. So what is our bias today? It's the bullish bias. We're not trying to pick the top on the daily chart. So we're focusing primarily on being long. When do we start looking at the charts? At 7 o'clock in the morning, it starts the New York session. Do you need to be in front of the charts at 7 o'clock? No. Can you start at 8:15 and wait for 8:30? Yes, that's a good time too. You're not locked into that, because I just told you at the beginning that every single hour you can scalp. Every single 15 minute, there's a scalp. Every quarter part of 1 hour, there's a scalp. But it isn't going to run 100 handles all the time. So you have to strip it down. So what's the minimum that I would like to see for trading and scalping the NASDAQ? It's 10 handles. If I can't at least make 10 handles, and I'm going to tell you how to determine that, okay? But if I can't make at least 10 handles, I'm not willing to take the trade. I don't care. I'll let it go. And there's lots of setups that I see all day long intraday, if I'm from the charts, that I will say, okay, I think it's going to do this, but I don't want that one. And I'm going to tell you how to determine that today. So if we look at how the market dropped down and it took out these lows here, see how they're relatively equal? See right there? I'm going to take this vertical line off because it's a little too aggressive. When we see that low right here on the 5-minute chart, see it right here, right above my cursor? That is this low right there. Okay. Go to the left of that low. What do you see? That's a down close candle. That is an order block. Friends and neighbors, that's not a supply and demand zone. Okay? It's not. What this is a candle that is opposed. It's closing lower. So it's a down close in a market that's predisposed to go higher. Why should it go higher? Well, go up one time frame from the 5-minute, and it's the 15-minute. What's right here? See these smooth highs right here? I'm going to annotate that there. Okay? So you see this high right there? Look where it goes to. It goes right there, stops, and comes right back down. And does what? It unsettles the longs that had a stop loss right below that low right there. And then the more prominent run takes place. And it's reaching up into this high. So on a 15-minute time frame, whether I'm scalping, whether I'm day trading for the full daily range, or if I'm short-term trading, regardless of whatever I'm doing, I am always referring to the 15-minute time frame as my bellwether time frame. Because on the 15-minute time frame, let me maximize this real quick here. On the 15-minute time frame, this is going to give me all of the salient points of liquidity that I believe is going to be pertinent to the session that I'm going to trade or about to trade. And it also will have the built-in advantage of showing me the daily levels that I'd be interested in if I'm going to trade the full daily range. If I want to get the lion's portion of that full daily range, whether it be an up day or a down day, I can determine those points of liquidity, whether it be buy side or buy stops, or sell side or sell stops. I can clearly and easily see them on the 15-minute time frame. And I can also see all of the pertinent imbalances, whether it be a sell side imbalance, buy side inefficiency, or buy side imbalance, sell side inefficiency, meaning a fair value gap with an up or down close. If we see this setting here on the 15-minute time frame, now think, we start the day at midnight, New York local time. That's the beginning of the new day. What does the London session do between 2 o'clock and 5 o'clock in the morning? Folks, I would have paid money for someone to teach me what I'm going to show you today. And you're getting it for free. That's worth a thumbs up. All right, between 2 o'clock and 5 o'clock in the morning, that is the London Open Kill Zone. Why is that thing taking forever to make a box? There you go. So from 2 o'clock to 5 o'clock in the morning, what's the market do? It drops. This here is a Judas swing. A Judas swing is a fake price run for the express purposes of taking traders out of potentially profitable traders, position being long in this case, or to put them into the opposite direction, because there's always going to be traders out there that trade a breakout. I'm not a breakout trader. We'll talk about breakaway gaps today too, by the way. The idea of focusing on a bias that is bullish on the daily chart, weekly chart, and monthly chart, we're expecting higher prices. We're not resisting the likelihood of higher prices and a new all-time high on NASDAQ. So because of that, in my mind, I want to see what price does between midnight going down into 2 o'clock. Is price dropping? Yes. Is it dropping to some random level? No. Look over here. Below that low is going to be what? Sell stops. So traders that see this low and break below that and it's consolidating, someone's going long there. I don't need to know who it is. There's always going to be buyers and sellers. Always. But that buyer or seller pressure is not what causes the markets to go higher or lower. The markets are absolutely rigged. They're engineered to go higher or lower because whatever the market is in fact trying to reach for, buyers or sellers, they're not pushing it there. The market's going to go to where the liquidity is, and it will keep repricing until it gets there because it's a game that's controlled by them, quote unquote. Okay. If you understand that and just warm up to the idea that it's rigged, initially it sucks when you think about it because you think, well, I have no chance. But when you realize it is rigged, now you do have a chance because it's rigged. It's not random then, right? So if we're bullish and we see that they did in fact take out traders that had stops below here at a time of day when it creates the high or low of the day, not all the time, most time, between 2 o'clock and 5 o'clock in the morning, London will create the high or low of the day, whether it be Forex, whether it be index futures, it doesn't matter. This is a truism. Do not take my word for that. Go into your charts and study it. Now, because it does that very thing here, right at 3:30, and that's an interesting time because if you go through my private mentorship core content lessons right on this YouTube channel for free, you'll hear me even teach about that right there. And that's the low of the day. Now, when it creates that low, we want to see some kind of displacement to the upside. Because if it does do that, that's indicating the algorithm is flashing like a billboard sign to smart money who trades on it. It's going to go up now. So focus on seeking a premium price. So what is a premium price? It's going to be a short-term high because right above short-term highs is going to be what? Buy stops. And or a fair value gap above market price. Okay, so if we went down here, where is there a old high and where is there an imbalance? Well, between this low here to this candle here, what is that? That's an imbalance. It's a sell side imbalance, buy side inefficiency. A fair value gap that has a down close is a SIBI, sell side imbalance, meaning it moved predominantly more to downside, and it's inefficient in its buy side delivery, meaning since it's one big candle that went down and closed lower, you want to find the previous candle to it and the candle after it. Those are the range extremes that you're annotating. So down here when it hit the stops, first thing in my mind is, okay, how do we trade after that? And it should go into this gap here, which is being shaded. Does it do that? Absolutely it does. Then it creates what? Another gap here. This is a buy side imbalance, sell side inefficiency, because it's a fair value gap that has an up close. So while I'm looking at price action in response to this area here, I'm also now measuring the willingness to see price find more support in this fair value gap. So I'm looking at it like a rock climber would, okay? I look at this entire drop here as a rock or cliff on a rock. And I want to climb all that. I might not be successful making it all the way up to the high or to the zenith of it, okay, the top of it. I might not be equipped to be able to get there, but I might be able to climb up high enough and get the memory or the visuals or maybe a picture of being at that point. Well, in that case, it's here, which is what I mentioned earlier when we were looking at price action on the 1 minute chart. But when price starts to run up in here, it goes into this area here and just comes into the high of that candle right there. So what's above that? Another gap. We'll get to that in a minute, okay? But the market rallies up and it leaves this imbalance. Okay, I'm going to move this box over a little bit by one so that way we can see. And I'm going to zoom in also. I promise you folks, this is exactly what's missing from you watching price action live. When you start looking at it like this, I promise everything will start clicking and it'll feel like it's illegal for you to know what you do. So this buy side imbalance, sell side inefficiency, I'm annotating the high of that candle and the low of that candle. And I'm focusing on the range between those two price points on this candle here. So when you see me putting rectangles on my chart, that's not a supply and demand zone. I'm looking at how this offered buy side imbalance. It's inefficient in the scope that it is not offered enough opportunity for people to sell. It's moved one-sidedly on this time frame, the 15-minute time frame. So I'm anticipating price to want to do what? Offer price on the downside, or offer it through sell side delivery. This is buy side delivery when price is expanding higher. This is sell side delivery when it's offering price as price is dropping. Since I seen it price drop down here, and I'm bullish longer term, I anticipate this as a stop run. I don't need to buy down here. I don't need to. I don't need to be awake. In fact, I wasn't to see this. If I was awake at the time, I would have went long in here. And then I would have pyramided in here and added more. And then I would have pyramided right there where you're going to see where I entered. This is the only trade I took today so far with this paper trading account. This right here, we're going to get into that in a minute. We'll go back to this for a second. So think about it. It goes down here to take the stops on a day when we're bullish. Okay, wonderful. Does the market immediately react by going higher after it goes below that low? Yes, it does. And also notice where the bodies are. See, the wicks they're trading down and past that low. That's the damage. The bodies are telling you, it's like if you were at a card game, okay, and you had a Confederate working with you, someone that's going to cheat the game with you, and you're trying to beat the players at that other side of the table with you, and nobody knows that you're in cahoots with the guy across the table or the dealer. They may flash their cards, okay, and tell you, this is what I'm playing with. Well, that's the equivalent of what's going on here with these bodies. You see where the close of this candle is here? Yes, this candle went all the way down there, but then closed right there. And then this candle opened, went all the way down here, past that low again, and then closed right there. And then we opened on this candle and tore off. That to me, listen folks, listen. This is where you're supposed to be writing things down. If not, at least put down the time marker. Just hover over top of the little window down here. It tells you what minute marker this is. And write this down, okay? How do I know when to trust a fair value gap? Well, first I have to have a bias. Okay, am I bullish or bearish? Because the narrative is going to build the idea of whether or not I'm going to be bullish or bearish. The bias cannot be derived until you at least confer with what the present narrative is. But the body's respecting the fact that it didn't close below that low. That tells me that this was a stop raid. So what does that really answer? Well, it answers, how do you know it's going to not go through that low and keep on going? I don't know in the first candle. I want to wait and see when it closes. It closes here. Then I want to see the next candle. What does it do? Does a little movement below that, but then the body stops there. What is that? That candle's closed right there. What is that? That's a swing low. Go back and look at the videos. That's a swing low. At a time when I'm bullish, at a time of the day when it creates the low of the day, if I'm bullish, it's knocked out traders that are long that had sell stops below that. So we crossed all boxes off that this is a high probability reversal in a day that's likely to go higher. You see how all these things come together like a dovetail. It's beautiful. It's perfect symmetry. If you wake up at 8 o'clock in the morning, 7 o'clock in the morning, anytime before the opening bell at 9:30, I look at the overnight session and see what it did like this. I look at London's trading from midnight to the London Open. And my London Open kill zone is 2 o'clock in the morning to 5 o'clock in the morning, New York local time. So back to this. How do you trust fair value gaps are good for longs or shorts? Or in this case, we're bullish. And we do see the signature that we did run stops, and this candlestick closes above the low that was taken out for stops. So that right there is my first indication that that's a very high probability reversal point. But I don't need to buy it yet. I don't need to buy it yet. You don't need to buy it yet. Ego says you need to buy it there. You don't. You wait for the next candle. Does it create a swing low? Yes. What is a swing low? A swing low is a candlestick that has a low right here, right above my cursor. And then the low that takes out that liquidity below that low over here. So we have a lower low in that candlestick. And then the next candle, when it closes, has a higher low than this candle here. So what we're saying is a swing low, if you'll allow me to draw a real quick, crude depiction of it. Don't worry about the colors because that's not significant here. But a swing low is this. It's any swing point in price. When the price swings up and it makes some kind of a turning point and starts to move lower, the opposite would be seen here like this. Come on. That's a swing high. A swing low is that. Okay, it's 3 bars, 3 candlesticks. And the length of these, okay, this has no bearing on anything. It could look like that, or it could look like this. You just need to have 3 of them, okay? That's also part of Power 3. It'll be in the book, trust me. Oh, you're a tease, ICT. Well, I got to do it somehow, right? I got to get you worked up. And a swing high could look like this, where the first high of the 3 bar candles is lower than the highest one and still lower than the third candle's high. Or it could look like this. As long as there's 3 candles with a candle to the left with a lower high and a candle to the right with a lower high than the highest one, that's a swing high. It doesn't matter if this high is higher or lower than this high. It doesn't matter. You just need 3 of them to cause a turning point. So when I see that in price action, it gives me confidence to trust that was a rate on sell side below that low here. And then the highest probability trade is to wait to see if there's displacement. That means I'm letting it, or let me properly phrase this. If I had been awake, I would have allowed for this move to occur and then tried to buy something down here. But let's say I didn't get it. Say I missed it, or I walked away from my computer and I missed the ideal entry. Then I'm going to wait. I'm going to wait for this right here. I want to see it dig up into this. And this is going to be very hard for me to have this on the chart because there's a lot of stuff going on right now. Remember, this is the sell side imbalance, buy side inefficiency between that candle's low and that candle's high. Let me take this off for a second. I want to see it run up into these extremes from here to here. I want to see how it trades there. Does it trade all the way up to and close above halfway? Halfway what? This gap. So if we take the fib and measure that, here's 50% of it. Does it close above that? Yes. So what does that tell me algorithmically? That it's going to use this imbalance here, okay? It's going to use that as a draw on liquidity. And now I want to see it do what? Work its way back down into this gap from this candle's high and that candle's low. This gap right here, I'm only going to refer to it in terms of its consequent encroachment, which is the midpoint of that gap, the 50%. And I would use that on a lower time frame chart to see if it's going to offer me an opportunity to go long. But it's already fulfilled its role here by drawing price up. So what does it tell me at that point? It tells me that, okay, this was a stop hunt. The market does what at that point? It's going to seek inefficiencies above price. Well, it did that quickly here. Where's there other inefficiencies? Right in here. And where are the buy stops? Above that high. and it's relative equal highs rather. So there's buy side above the market right there. So those buy stops, once these sell stops have been taken, smart money does this. It buys sell stops and sells to buy stops. You see what it did here? It went below that low, accumulated long positions with willing bodied sellers at a low price. Why? Because somebody went long here. Do I need to know how many, and who it was? No. You don't either. You don't need a book map. You don't need a ladder. You don't need depth of market. You don't need all these things people say, oh, you're tape reading. Show me what you're doing with level 2 data. You don't need any of that stuff. But now we're back into this discussion right here. So this becomes my primary focus because I want to be a buyer on a day like this. You would want to be a buyer in your demo account on these days. I got to be consistent, making sure you don't see this as investment advice, folks. All we're doing is we're studying the future probability of price delivery. Okay, that's really what we're doing here. Okay, if you cross the line and you say, I'm going to take real money and put it in the market and risk it doing this, you have made that decision. I never tell anybody to do that. Okay, but there'll be probably a day that comes in the future for some of you sooner than others where you feel confident to do this with real money. I don't want you blaming me for your wins or your losses because you earned them both. Okay, so just be aware that I have opened this discussion up like I do all the time. I'm teaching with a demo account or a demo trade or paper trading account for my legal protection. But we're all watching real-time price action. It's all happening live. Okay, and if these things don't work in live market conditions, whether it's a demo trade or a paper trade or even tape reading, which is what I want you to start doing. Don't push a button even in a paper trading account. Don't try to go out and get your funded account challenges passed. You need to do this for a couple months. Because once you get confident and you know what you're looking for, when price shows you this displacement to the upside, and then you wait patiently for it to trade right back down into this candlestick's movement higher, the market will want to offer down close or down expansion candles, which is sell side delivery. It really means simply this. The market moved up right here, one candle. And between this candle's low and that candle's high, there has not been any movement to the downside, which would be an efficient delivery of price action. If this was paint, and I've said this analogy before, you apply the paint with a paint roller to your wall right here. You roll it up, and then as you roll it up, the more you go up, you'll start seeing that the paint doesn't fully get applied to the wall. So what do you have to do to fix that? You roll the roller right back down over top of where you started to make sure there's an efficient or ample amount of paint between here, which is this candle's high, all the way up to this high now. Because if we went back all the way down here, so now what we're going to do, we have all this wall up to these highs to paint. So as an analogy, you're watching price paint on that canvas between this candle's high and these candles' highs. So it first started off real quick right here. So it wants to come right back down. And what that does, it affords smart money, traders that know how to use this tipping of the hand by the algorithm, to now enter, to get long, accumulate long positions. Where would they buy? I told you I'm giving you all the answers today. If you look at the high to the low, okay, I'm going to take these extensions off because I don't want them drawing any attention because they're not useful here. Okay, I'm not trying to hide something from you. I just want to make sure that we're looking at the pertinent levels here, the salient points, if you will. Here's the midpoint of that big up close candle. Okay, see that? We went past it, yes, but look at where the bodies are closing. Are they closing at or below that candlestick's high? No. Did we trade to that candle and through it? Yes, because we allow the wicks to do that. Remember, the wicks do the damage. So when you're using stop losses, I'm looking at where those wicks have done the damage prior to my entry or before I move my stop loss. And because I see damage was done here, and I know that it can overshoot this a little bit. Okay, so if I was long down here, my stop loss wouldn't be jammed up underneath these bodies. Because if it was, I would have been stopped out prematurely. So the fact that these candles are closing above the high of that candle, which makes this a buy side imbalance, sell side inefficiency fair value gap, trading down to that inefficiency, and these candles bodies not closing at or below tells me that we're really going to move higher and attack at the very minimum these relative equal highs. And because we're on a 15-minute time frame chart, we're going to attack that high, which I told you live that we would draw to, and it did. Okay, by in and of itself, that is all you need as a model. That's it. I didn't need to create a higher high of the day. I didn't need to move 100 handles or 100 points. You don't need that. In the beginning, you need to know what you're looking for on a very small scale, and that's 10 handles. Okay, minimum 10 handles. If it can't move 10 handles, then you don't do anything with it. Okay, but as price moves up in this range here, we want to determine how we can also scale in, because say you didn't get in down here towards the lower end, below the 50% of that gap between this candle's low and this candle's high. And I'll add that rectangle so that we know what I'm referring to visually. Because if this is your first time, it's probably going over your head. And I'm trying to be very, very thorough, but not too thorough to lose you. But this big candle here, it creates an imbalance. And when it trades down like this, you want to be buying in that. Okay, I have students sometimes say, well, why are you buying here and down in here? Why don't you just buy one time? Well, because the market could go down just a little bit and then stop right there and go higher. It can go down to the midpoint of the gap, which is this level here, and go there and stop and go higher. Or it can go all the way down and close, or go past it a little bit like it does here. And I don't know that, but I want to secure my largest position. I'm doing my largest entry first. So if I was buying, like say for instance, I was going to do a position of 10 contracts, I would go in at 6 right here at the upper quadrant. He's teaching quarters theory. No, I'm not. No, I'm not. Here is 25%, and we'll toggle to 75%. Okay. And now what that does is it grades in quarters the low and the high of that buy side imbalance, sell side inefficiency. See that? So I could be buying right there at 6 contracts. I can add 2 more there and 2 more there. So I would be positioned for 10 contracts. Yes, my 6 contracts would be in a little bit drawdown when it trades to here. And then it would be in further drawdown because I add 2 more there when it drops down to here. I'm completely fine with that because my risk would be affording a move down to this candlestick's consequent encroachment. I'm at least considering it going to at least move that far. Now, why that? Why that? Because the likelihood of it coming all the way down to halfway of this wick, while it's possible, it's unlikely to do that. Why? Because we had that swing low there. So this wick went lower than this wick's low did. So this is the one that if it's going to reach into a wick or midpoint of a wick, it's going to go into that one as an extreme. And you can see we did go past it a little bit, but we didn't even get to the midpoint. See that? So that's how I would have placed my stop and managed my stop there as I was entering here, here, and here. And some of you might think, well, that's a lot of range. Well, it's relative to your account balance. It's relative to what you're willing to assume in risk. If the risk is too large and I can't facilitate that risk percentage on 6 contracts, then I would start with 4 or 3 or whatever. And then I would have to work with adding singles as that worked higher up. So it's how I'm balancing my total risk based on my equity. And then also what I anticipate is permissible in the current market structure. What is it likely to do? What is it unlikely to do? And then where's the gray area that feels like it's the highest probability of me being efficiently executing and not absorbing or taking on considerable risk and affording myself the potential for price to run in my favor. So if we have this here, I'm going to drop out of the 50-minute chart because everything I'm annotating here we'll be able to see on the 5-minute chart. I want you to see. Now over here on the 5-minute chart, I'll maximize it. Now look what's going on here. We drop down. Look how much work they're doing at the lower quadrant, the 25% from this candle's high to that candle's low. So there's 5 points inside of that range that I'm interested in. It's obviously the low, it's the high, and the midpoint, but there's 2 quadrants, the upper quadrant and the lower quadrant. Look how price is behaving. See what it did here? See how that overlaps with this down closed candle's high? That's an order block. It's not just a down closed candle that makes it an order block. It's the narrative that it's a bullish day. We did come down into this and close up that buy sign imbalance, sell sign inefficiency. And then does price support at the lower quadrant? Look what it's doing here. Is it doing it? Yes. Is that quarters theory? No. Is it algorithmic? Absolutely. And does the market run higher there? Yes. And it drops right back down into this buy side imbalance, sell side inefficiency, that one single candle, which is the same thing we're annotating on the 50-minute chart that's seen here in 3 5-minute candlesticks. That singular one pass higher there is a replication of this larger one just in a smaller time frame. But look what it does. It allows you to see if it trades back down into the upper quadrant, which is completely permissible, and it trades down to this candlestick's high. What is the candlestick's high? Look right up here. What's the candlestick's high right there? 17,450.25. This candlestick trades down to a low of 17,448.75. Is that a lot of difference? Is that a lot of drawdown? No way. Absolutely not. And the market does what on this candlestick here? The low. 17,450.50. Only off by a quarter point. A quarter point. A tick is what that is. Order block, inefficiency, bias is bullish, sell side's taken, relative equal highs is your first draw, and 15-minute buy side up here. It was told to you when it was happening live. What did the market do? It rallied. So this would be an area where you can be a buyer too. This would be a real good area for me. If I was missing everything down here and I didn't do anything down here, I didn't do anything here, I could be buyer right there as it drops down to the upper quadrant because it's filling in that inefficiency there. And I'm anticipating and expecting price to do what? Expand to draw into the buy stops.